Hi, folks. Welcome back to Murthy Finance Academy. Today, we will discuss some key players in the cables and wires industry. So, the first company which we are going to discuss today is Polycab India. But before we start, a quick disclaimer: I'm not a SEBI registered analyst. Whatever the companies we're going to discuss purely for educational purposes only. Please do not consider it as a buy or sell recommendation. Now, let us start. Polycab India is no longer just a cable company. It is a volume monster in the midst of a high stakes evolution. Through Project Spring, the company is pivoting from a pure play industrial manufacturer to an integrated, fast moving electrical goods powerhouse. While wires and cables still provides the heavy artillery, FMEG and EPC segments are being groomed as the flanking maneuvers for the long term diversification. The recent redesignation of Bharat and Nikhil Jaisinghani as joint managing directors effective Jan 2027 is a clear signal of professionalization. This isn't just a title change, it's a move to institutionalize leadership as the company scales towards its ambitious fiscal year 2030 targets. If you see its major revenue segment contributions, the wires and cables nearly generated 88.3% revenue in Q3 fiscal year 2026 and 87.4% for 9 months fiscal year 2026. So here robust volume momentum is the main key driver. And coming to its FMEG segment, for Q3 fiscal year 2026, it generated 6.4%, and for 9 months, it generated nearly 6.9% of the total revenue, which is profitable for the 4 consecutive quarters. And the third and last segment is EPC or other segment. It generated nearly 5.3% of the revenue, and for 9 months, it generated 5.7%. So there is a 12% year-on-year decline in the 9 months. So the shrinking EPC mix is a deliberate move toward higher margin O&M led project work. So India is currently the global clear out performer, and Polycab is riding the crest of this infrastructure wave. The TAM is expanding on the back of a massive government capex push of 6.6 trillion, which is 59% of the total fiscal 2026 outlay was utilized by November 2025, marking a 28.2% year-on-year increase. While global trade is snarled by US tariffs and shifting supply chains, India's domestic story remains insulated. Real estate launches in top 7 cities are hitting decadal highs, and a revival in affordable housing is providing a sturdy flow for wire demand. However, this growth isn't free. It comes amid an unusually sharp escalation in metal prices that is testing the pricing power of every player in the sector. So Polycap's execution remains best in class, but the divergence between domestic fire and international smoke is stark. So the company's domestic wires and cable segment delivered an exceptional 59% year-on-year growth. Wires outperformed cables as channel partners scrambled to pre-stock inventory, hedging against a copper price that has become a runaway train. Second, international business, a laggard in this quarter, growing only 5% year on year and contributing just 6% of the total revenue. High bases and global trade jitters have temporarily stalled the export engine. So here management employed a staggered pass-through strategy. In plain English, they ate the margin hit to starve the competition by not passing on the full 21% quarter on quarter copper spike immediately. They secured a massive 40% volume growth. It's a classic land grab, prioritizing market share today at the expense of the P&L tomorrow. So the Q3 fiscal 2026 income statement reveals the literal cost of market dominance. Revenue is screaming, but margins are bleeding. So the company's consolidated EBITDA margins contracted to 12.7% versus 13.8% last year. The wires and cable segment saw a 300 basis points QOQ EBIT margin decline to 12.1%. Beyond commodity lag, a 219 million one-off gratuity provision tied to the new labor code shaved 30 basis points. Unlike the cyclical copper spike, this labor provisioning represents a structural step up in long-term liabilities. And while Polycab reports a lean networking capital cycle of 27 days, looks under the hood. This efficiency is driven by 36.1 billion in acceptance payables days at nearly 127. The company is essentially funding its massive 60.1 billion inventory buildup using high volume letters of credit. This is an accounting mirage. Operationally, the cash is tied up in record high inventory to feed Q4 demand. So, Polycab is a volume monster currently eating its own margins to starve the competition. The 12.7% margin is a buyable blip if you believe in their market share gains, but the low working capital is more about clever financing than actual operational speed. So retail investors shouldn't be blinded by the 46% revenue growth. The real story is in the realization delta. So here volume versus value delta, if we see, the domestic volume grew 40%, but revenue grew 59%. That 19% gap is your realization gain, proving that while they are staggering the pass through, they still have enough muscle to hike prices significantly year on year. ROCE also remains elite at 31.8%, though it's down from 35.8% as seen in Q2. So the debtor days also steady at 38 days, showing the channel is healthy despite the restocking frenzy. And coming to capacity utilization, with 9 months capex at 10.9 billion rupees, Polycab is aggressively expanding the floor. Current utilization remains high to support the 40% volume surge, but the project spring capex is the real lead indicator for fiscal year 2027 and 28 volumes. So if you see its con call highlights, the con call was a defensive masterclass. Management was blunt. They saw a 35% rise in copper from April to December, including a 21% spike in this quarter alone, and chose not to break the markets back with instant price hikes. So management missed the historical 13 to 15% margin comfort zone, hitting 12.7% only. While they delivered on the project spring capex guidance of 12 to 16 billion annual target, the staggered pass through is a risky gambit. If the copper doesn't cool, the temporary margin dip could become a permanent derating trigger. So here the Polycab's display is very currently thin. They highlighted QR coded results and digital condensed statements for standard transparency tools, not deep tech integration. Investors looking for AI driven manufacturing efficiencies won't find them in the narrative yet. So management sounds confident because the BharatNet win, which is a 8 billion total revenue visibility, gives them a massive O&M tail for the next decade. They aren't apologizing for the margin miss. They are framing it as a strategic investment in market share. So if you see the valuation, the Polycab is always priced for perfection. So company's current PE is trading at nearly 49 times of the total earnings, a significant premium to its 5-year average of 38 times. So while the peers like Havells trades higher due to its consumer heavy mix, Polycab is now valued significantly above KA Industries, which is nearly at 50 times, reflecting its dominant 40% volume growth. The divergence 47% 9 months PAT growth is spectacular, but if margins don't meet, revert to 14% plus, the current multiple will be hard to defend in a volatile commodity environment. So the stock is expensive by any historical standard. You are paying a premium for a debt-free compounding machine that grew volumes by 40% while the rest of the world struggled. It's growth at any price territory. So coming to some key red flags I observed in this company are commodity volatility. The 35% cumulative rise in copper since April 2025 is the primary threat. If the staggered pass-through takes too long, earnings will miss. And the dependence on 36.1 billion in acceptance to maintain networking capital cycle optics is an accounting mirage. And BharatNet execution, 4.5 billion in project execution carries timeline risks that could drag down EPC margins if delayed. And the last one is labor cost. The 219 million provisioning for the new labor code is a recurring structural cost, not a one-off. So what are its key strengths? Market share dominance proven by 40% volume growth in wires and cable segment. Fortress balance sheet, 30.3 billion net cash provides an unmatched safety net. And coming to weaknesses, margin vulnerability, 300 basis points QOQ contraction in wires and cables, a bit due to post cost push lag. And second weakness is unfavorable mix shift, lower export contribution, only 6%, and higher institutional sales. Coming to opportunities, solar scaling, two times growth in solar via rooftop incentive schemes. And second is BharatNet life cycle, 8 billion in total revenue visibility. And coming to threats, copper hyperinflation, 11% rise in December alone suggests the staggered pass-through isn't over. And the second threat is regulatory drag. If the new labor code implementation impacting long-term provisions. So many brokerages consistence remains by though targets are being tampered by the margins miss and the 35% April to December copper run up. So we need to see whether these will play in the company's favor or not. We need to observe. And some key monitorables are margin mean reversion. Can the wires and cable segment margins return to 13 to 15% by Q1 fiscal year 2027? Is need to be watched out for. And it's acceptable levels. If payables drop, watch the NWC cycle balloon back to 50 plus days, and copper to rupee stability. Further INR depreciation will exacerbate metal import costs. And FMEG mix shift, sustainment of 1.5 to 2 times industry growth targets. And BharatNet milestones, whether it will timely execute the first phase of 4.5 billion phase or not, to be watched out for. And institutional versus retail mix, a tilt toward institutional sales will continue to weigh on margins. So as a summary, Polycab's Q3 fiscal year 2026 results are a masterclass in brute force market capture. Management is essentially using its 30 billion cash pile to buy market share by absorbing commodity shocks that would crush smaller competitors. While the 12.7% margin and the acceptance led NWC cycle require a cynical eye. The 40% volume growth is an undeniable testament to their execution. So, what is the bottom line? Polycab is a volume monster currently eating its own margins to starve the competition. Buy the volume, but keep a hawk like watch on the copper pass through. So, hope you like this video. If you do like this video, please do like, share, and subscribe to Murthy Finance Academy. Thank you.